Good morning. This public meeting of the Investment Committee is being held at 30 North 3rd Street, Harrisburg, Pennsylvania. By participating in this session, you are consenting to the recording, retention, and future viewing of this meeting. Although being live streamed via the internet, this meeting is a live in-person meeting open to the public in accordance with the Sunshine Act. The live streaming of this meeting is presented as a convenience and is not provided as the official means for public attendance. In the event the live stream fails or cannot be transmitted for any reason, the in-person public meeting will continue without interruption. Please proceed with the meeting. Thank you.
Thank you. I'd like to call the September 30th meeting of the SERS Investment Committee to order and ask for a roll call.
Secretary Munson.
Here.
Mr. Enders.
Present.
Mr. Faber.
Here.
Representative Frankel or designee.
Matt McCary here.
Mr. Galuska.
Here.
Treasurer Garrity or designee.
Here.
Senator Hughes or designee.
Matt Lindsay on behalf of Senator Hughes.
Representative Miller or designee.
Here.
Senator Robinson or designee.
Stephanie Buchanan on behalf of Senator Robinson.
Secretary Spiker or designee.
Jeff Soderstedt on behalf of Secretary Spiker.
Thank you.
Thank you, and thank you all for being here. I know we have a lot on the agenda, so I'm just going to move forward. Next item is consideration of the minutes from the Investment Committee meeting of July 22nd, 2025. Do I have a motion to approve the July 22nd, 2025 Investment Committee meeting minutes as presented?
So moved.
Is there a second?
Second.
It's been moved and seconded. A simple vote, so all in favor, please say aye.
Aye.
Any opposed? Seeing none, it carries. I don't believe there's any old business or special presentations, and so we can move on to new business, and I'll turn it over to Jim.
Thanks, Chair Monson. Good morning. Today we're going to start with a capital markets update and performance for all three plans, DB, DC, and DCP. We have the RBK team, Jason, Tony, Jim Voico, and I believe Sarah's on virtually as well. Okay, so if you want to take it away, and then they'll roll right into do the capital markets update, and then feel free to roll right through the performance on the plans. Thank you.
Because I know that we have a crowded schedule. There's an old saying that every downturn in the market is different, has different drivers, different characteristics, and so on. So does every upturn. And the upturn that we are currently benefiting from, where all of us as institutional investors, is peculiar in its own way. Just to give you a couple examples, we have gold soaring and the U.S. dollar down. Usually those are signs of worries over inflation. But if you look at the TIPS market, break-evens have been very, very stable. So investors are simply not reacting to what's happening with gold or the U.S. dollar, at least not yet, with respect to the TIPS market. So something has to give over time, but it is one of the characteristics of this upturn that is unusual. Another is that the Fed is actually starting to cut rates despite failing to meet its inflation target. That was something that was talked about as a possibility, seems to be coming true. They signaled 2 additional cuts beyond the current one, despite the fact that inflation has not even come close to their 2% mark. An oddity. We have constant talk of recession fears, but the most recent quarter of U.S. GDP was actually revised upward. And despite all of the reasons for volatility, whether it's a potential government shutdown or all of these other things that we look at, whether it's tariffs or geopolitical, the VIX has been very quiet. So there are many anomalies in the market today that mark this upturn as different from others that we've seen. So we'll have more discussion about this when we get to asset allocation in a meeting that's coming up very soon. So I'll stop there.
Well, thank you. I'm Jason Smansky. I'll be covering the defined benefit plan, and then I'll turn it over to my colleague Sarah Bochter, who's online, to cover both of the defined contribution plans. If you wouldn't mind turning to page 14 of the quarterly executive summary. On page 14, as that's coming up, this is the top line headline numbers for the PACERS fund. It's also versus a peer universe, and it also has your custom benchmark as well. These numbers are the gross of fee, and they're as of June 30th, 2025. As Jim just mentioned with the upturn, when you look across the page, with the exception of the very last column, all the numbers are positive. And when you look over the longer term, over the 5-year, 7-year, and 10-year, the numbers are also above your actual benchmark of 6.875. Later on in the agenda, we'll be doing a little bit more of a thorough analysis of the asset and liability, and we'll be spending some more time talking about certain risks. When we look at the universe rankings as well, again, all within the top half, which is the area that you want to be. At the same time, as Jim mentioned, there still is some uncertainty within the marketplace, and so we're looking to build a portfolio that's a little bit all-weather. At the same time, there are characteristics embedded within your returns, and when you look at the numbers, it's really a growth orientation. Part of the reason why I say that is, again, if you look at the one negative number, which again, you have to go back to 2022 in order to see it, every single plan was down. The markets were down close to 15%, and this is the equity markets. Again, the PA-SERS plan was also down, but again, when we looked at the universe ranking there, it's actually below the median, the area that you hope not to be. But again, that's because of the unique characteristics in terms of having a growth orientation within it. At the same time, we're always conscious of the risk-adjusted numbers, and if you could flip the page to page 15. When you look at the multi-statistics on the bottom of the page, the first real four, starting with the Sharpe ratio, the tracking error, the information ratio, those are risk-adjusted numbers that we're consistently monitoring and thinking about ways we could potentially improve them. At the same time, when we look at where we are today, and these are 10-year numbers as of a moment in time, and we look in terms of the absolute number as well as the universe ranking, again, it indicates that we are using risk appropriately, and any measure of risk we're being adequately compensated for. The one figure I always anchor to is the information ratio, which is the one in the middle. What that is it has both the excess performance as well as the excess tracking error, the excess risk within it. Well, the number's only in just barely positive 0.07. Again, when you look at your peers and we run it against a similar universe of public plans that are over $10 billion in nature, you're actually in the top quartile within the universe. So again, it's a way to indicate that risk is being used appropriately and you're being compensated for the amount of risk that you're taking. At the same time, we know there are different types of risk. And if you could turn to page 17, one risk we're constantly monitoring is liquidity risk within the portfolio. The number at the very bottom, which is the column, which is the row that is cumulative months of benefit payments at 75 months, that indicates based on the amount of interest, the amount of contribution, and if you were to sell down all those assets, you would have roughly 75 months in reserve, which is a little bit conservative considering the nature as well as the orientation of your plan. At the same time, as Jim also mentioned, markets can be unpredictable, and so you always want to have that rainy day fund. I'm going to pause there and see if there's any questions. When we look through the rest of the plan, the asset classes and the managers, again, we are pleased with the path of performance that has occurred.
Thank you for that. A question about the 75 months of SERS. How does that rate relative to other funds of the same size, and what type of reserve do they have?
So every single plan is a little bit different in terms of their construct. Every plan is a little bit different in terms of their funding ratio. When we look at that 75 months, every plan tends to calculate the amount of reserves just a little bit differently. You are on the more conservative side in terms of how much you do have in reserves. There are reasons why to have it. Again, as we'll detail in just a few minutes, your funding ratio is a little bit lower than some of the other plans, right around at 68%. So again, drawdowns, which do happen, as we pointed out with 2022, it's always good to know exactly where you're going to go in order to receive benefit payments.
As Jason said, it's a combination of this board's risk preferences, as well as the circumstances of the fund. So your circumstances and given your funding level would tend to ask for a little more conservative approach, and your risk preferences have indicated that this is acceptable to you, if not preferable, for the time being.
So is there a number out there about how many months the average fund of our size keeps in reserve?
So there's no absolute number that we could point to. Again, it's based on a multiple of attributes and factors. What is the risk tolerance? What is the risk preference? Where could you potentially go in order to get liquidity, again, if there is a market drawdown and you do want to reinvest? It's a number that we're constantly discussing with staff. Again, a part of the asset and liability analysis we're going to present, one of the questions we had is, could the plan take on some more risk? And by taking on some more risk, we would look to reduce the cash and the fixed income allocation, potentially put more to equities. We're just starting that journey now. This is the first part. During the next meeting, we're also going to present an asset allocation study, which again would also present other options if there was a desire in order to reduce the amount in reserves.
And we're not aware of any database that actually tracks the number that you just asked about. And part of the reason is all the reasons Jason gave, and the other is that some funds, either because risk preferences change as trustees change, or their circumstances change, or sometimes they're run more tactically than the average fund, that number will change. Can change very significantly. This fund itself has had different cash positions over the last 20 years.
Thank you. I look forward to that information.
Well, there's no more questions. I'll turn it over to my colleague, Sarah, who's online to go through the defined contribution plans.
All right. Thank you, Jason. Good morning, everyone. Let's maybe first pivot to the deferred compensation plan. This will be attachment 6B2 in your materials. And if we can start on page 7 of that executive summary report, where it shows the manager monitoring dashboard. As of end of June, the deferred compensation plan stood at around just over $5 billion, reflecting strong market performance over the quarter. The plan, as you can see on this page, offers 3 distinct investment tiers to participants. For those who are looking for guidance and asset allocation from SERS, you offer the BlackRock Target Date Fund series as a default investment option. This is one of the largest in the US market today. You offer 10 age-appropriate vintages with allocations across global equity, fixed income, and inflation hedging assets. And that series of funds manage around 18% of total plan assets. For investors looking to build their own portfolios, either on their own or with the help of a managed account service, you offer 6 different core menu options that span US and international equities, fixed income, and capital preservation. You offer, actually, of those 6, 4 index funds that are managed by Mellon Asset Management and provide broad asset class exposure. These are passively managed funds that are meant to provide performance tracking to their respective broad benchmarks and cost efficiency. Around 80% of assets are invested in core menu options. And finally, for those who are looking for maximum flexibility, you offer them the self-directed brokerage window managed by Charles Schwab. It offers access to tens of thousands of funds and securities, and it holds around 4% of plan assets. This low usage is consistent with what we see in other DC plans as well. At this time, as you can see on this page, all those options are positively rated by RBK, meaning that we would consider them as best ideas in their respective spaces, and we think that they are likely to outperform peers over the long term. And given your decision to offer participants low-cost options and your ability to leverage your scale to negotiate those fees, as you can see on the page, your menu options all rank well above the average peer in their respective universes, and many of them rank in the top 10% across asset classes. If we turn to the next page, as DC plan fiduciaries, you have put in place a very clear policy for manager oversight and for when to place a manager on watch. This page is a custom page we created for you all to help you monitor some of the key metrics that your policy has identified for the DC plans as important to track to determine if a manager needs to be placed on watch. As you can see from this page, your policy is fairly comprehensive and it calls for a review of both qualitative indicators, whether the strategy or the organization have had any events that may impair the manager's ability to deliver in the future, as well as performance quantitative review as well, to make sure that the manager's performance continues to be in line with expectations. Overall, obviously for passively managed option, which is a majority of options here, the key performance measurement is tracking relative to the benchmark. And then for active options, we also look at performance relative to peers, as well as their ability to outperform their benchmark. Overall, happy to report that all your managers in this plan continue to be in good standing, meaning that we have no concerns with their ability to perform over the long term, and we have not seen or observed any new changes or adverse updates to or events that may impact or impair their abilities over the long term. Stable value obviously has, as an asset class, has faced some performance headwinds, just given the rapid rise in yields over the last 2 years, but we're seeing them recover and we do expect them to outperform over the long term relative to money market benchmark. And your stable value option has generally performed in line and outperformed the median peer. So no immediate concerns there as well. On page 9 and 10, these are new pages that highlight some aggregate statistics that we think are useful to track and keep in mind. We will not cover those in detail at every meeting, but since these are new pages, I'll just spend a couple of minutes going through them with you all. On the top left, we show the participant mix by cohort between active and terminated. In this plan, it won't come as a surprise to you all, but the majority of older participants that have assets in the plan are either separated or retired, so anyone above 60 plus. The top right-hand side shows average and median account balances and the total number of participants over the last 4 quarters. And you see that compared to last fall, the number of accounts has increased as well as the median balance in the plan, which is really good to see. The bottom left side shows the participant deferrals and participation rates across age groups. Deferrals, as you can see, are in the range of 6% to 12% and tend to be higher for older participants trying to catch up on their savings. And then participation peaks at around close to 60% for the 50 plus cohort before declining again. Those participation rates are not atypical for a supplemental plan like the deferred comp, but it's obviously always good to encourage and nudge participants to save here and complement SERS pension benefit or other income sources they may have. And then finally, on the bottom right side, we show the adoption of the My Total Retirement Managed Account service by age cohorts. This is something we also find helpful to track to understand the usage of the service across age groups and over time. As something we'll review with staff also in the coming months and take a closer look at that service for you. The next page focuses on how participants are using the menu itself. You will see in the green part of the pie chart, this shows the usage of the targeted default option. It holds about 18% of assets. We said 19% of assets and about 18% or so of participants. Micro retirement manages around 35% or so of accounts. And in total, if you group those together, you can see in the table that the do-it-for-me category has about 54% or so of participants who prefer to delegate the asset allocation itself process to the plan. And that number is actually very much in line with what we see in other mature DC plans. And in terms of the core menu options, about 29% of participants prefer to build their own portfolio using the core menu, and another 14% or so split assets between the core menu and the target date funds. In total, you have about 44% or so participants using the core menu options. And finally, as I mentioned earlier, the brokerage window has around only 3% or so of participants using this option. Overall, those usage patterns are not inconsistent with what we see in other plans. The only thing I would highlight is maybe match account usage tends to vary across DC plans, and sometimes we see that number being a bit lower, but otherwise everything looks very much in line. The rest of the report shows more detailed performance results for the individual fund options in the plan. But in short, no immediate concerns or red flags that we'd like to report at this time. Want to pause to see if there are any questions on the 457 plan or any comments on those new pages or anything else. All right. If there are none, we can move to the second item, the defined contribution plan, which is attachment 6B3 new materials. We can also start there on the same page, P7, which is the manager monitoring dashboard. Since I spent a bit more time on the new pages in the last report, I'll keep it shorter here and maybe focus on changes and anything important to flag for this plan. As of the end of June, the plan stood at around $366 million, up from $314 in the last quarter. This is due to a mix of performance as well as positive contributions. For do-it-for-me investors, you offer the same target date options. It holds around 88% of plan assets and serves around 96% of participants, so the majority of participants. You offer the same 10 vintages. For those looking to build their own portfolios, you actually offer 8 core options spanning US and global equities, fixed income, and capital preservations. 7 of them are managed by Mellon Asset Management, and this tier holds around 12% of assets or so. And finally, you also offer the same Charles Schwab self-directed brokerage window, which manages around less than 0.5% of assets. Also, not unusual in DC plans. In terms of managers' ratings and changes compared to last quarter, we look at that on the next page. Overall, happy to report that we have no concerning changes that took place over the quarter across your managers, and nearly all of them remain in good standing. The only exception is the all-cap US equity index fund, which is currently on watch and has been on watch for a while. And we've talked about this last quarter. There has been this unexpected tracking error taking place in 23 due to a large client redemption. Since then, the tracking error has came very much more so in line with peers, but we will continue to monitor them and to make sure that tracking error continues to normalize and becomes more in line with expectations over the 3 and 5 year periods. And we expect that to happen in the coming quarters. And unless anything changes, we do expect them to come off watch in the near future. The next 2 pages are also the same new pages I just covered. Maybe one interesting comment on this page, if you look at the top right-hand side, A majority of participants are active in this plan, as you would expect. On the next page, we also show the asset allocation. Majority of participants, as you can see, are invested in the target date fund, as I mentioned. And then finally, if you look at cash flows on page 12, you'll see that unlike the deferred comp, where there were more negative outflows than positive inflows, the majority of flows are actually positive contributions by active participants. In sum, no concerns here as well, and we'll continue to monitor the OCAP fund. Any questions to me on the GC plan or the deferred comp?
Any questions for Sarah or the team in general before we move on? Okay, you must have done a good job. Everybody's satisfied with that update. Very extensive, a lot of information on those reports, and feel free as always to reach out if you have any questions or concerns on them on a go-forward basis. Okay, thank you, RBK team. We'll be seeing you again shortly. In the meantime, Kyle Renfeld, our Managing Director of Private Markets, as well as the Stepstone Group consultant, represented today by Matt Roach. They're going to bring us up to date on the PE program, which has been making progress, as Kyle's going to cover, towards getting to the target, which had been overweight quite extensively a few years ago. But distributions have come in consistently and have helped us fund benefit payments, eliminating the need to sell off our private or our public markets portfolio. But Kyle, you want to go ahead and take that away?
Sure. Yeah, thanks. Good morning, everyone. In a second, I'll turn it over to Matt from Stepstone here, but I'll highlight a couple of points that Jim gave me a good introduction on. So first, our allocation to private equity as a percent of the total fund continues to come down. So we're currently sitting at an allocation of 16.5% of the total fund versus a 16% policy target. So a year ago today, the actual allocation was 18%. So the allocation has come down organically over the last year, which leads me to my second point, which is that over the 1 year period ending 3/31, the portfolio generated $335 million of net distributions to SERS. So $100 million of that came in during the first quarter, which is what we're reporting on today. And there's a slide in the report that includes those cash flow numbers, but I'll turn it over to Matt to take us through the report from the beginning.
Awesome. All right. Thanks, Kyle. I will endeavor to get through this relatively quickly and give some market updates here. Fortunately, not a lot changes quarter to quarter within this industry. So let me flip forward to, I think it's slide 3, a bunch of lines. Nothing new to say. Oh, yeah. Well, actually, this one's perfect. Nothing new to say on the last one. It's just account of managers. I think on this one, I'll pause and reiterate what Kyle said here and spend a couple of minutes on market. I've said this in prior meetings, and just to reiterate now, with the standard pacing plan, the way that you all are going to get back below the 16% target or to the 16% target is for the proverbial ice cube, the net asset value we have, to melt, to receive distributions in excess of the contributions that you're making to this portfolio. We've been there. And we've been getting good, consistent distributions. It's a big part of why we're down from 18 to 16.5. You all, over the last year, and I'm going to get a little wonkish for a second, then I'll back out, have gotten about a 13.5% distribution yield. So that's $900 million on about $6.8 billion of NAV. It's actually a decent number, maybe sounds pretty good. The reality is private equity over about a 25-year period is more like a 21 to 25% distribution yield. It's been a pretty material dislocation starting 22, 23, 24, now persisting into 25, which looks a lot like 2024 did, despite some expectations or some optimism earlier this year, where yields have really been in the 10 to 11% range. And so while 13 is certainly down from peaks, and I'm going to get to the point here in a second, it is in excess of the broader market distribution. And part of that is intentional, given the markets we focused on, real middle market focus. Part of it has to do with slower pacing. So we're making fewer contributions to the portfolio, but you guys have been getting good distribution yield in the portfolio. What may happen if past is precedent, and it often is despite disclaimers, is that when distributions accelerate or normalize back into the low 20s, we will receive distributions very quickly and go back below our 16% target very quickly. We've got a little bit of a vintage year gap over the last couple of years with slower commitments in those years, and so contributions won't pick up as quickly. And we've got a slide on unfunded in your portfolio, and most of it remains concentrated in the newer vintage years, unsurprisingly here. But I think we've got conviction that whether or not the market comes back, we'll get back in compliance with that 16% target. 2025 does not feel like the year of normalized distribution yields, right? It does not feel like the year of 20 to 25% distribution yields. It feels more like the low teens again, like the last 2 years have been. You are performing in excess of that. We continue to melt this ice cube. When the market comes back or mean normalizes, this ice cube may start to melt very quickly. And so I say all of that not as a retrospective for performance reporting, but just something to keep in mind as we're building the plan here. And good to be talking with the HarborVest folks later about backfilling some vintage years through secondary exposure as well. Okay, I'll move on to the next slide here. This is just PMEs versus the Russell over multi-year periods since inception. Good. We're not doing so great versus hot public markets over the last few years, which maybe isn't surprising. And then the next slide is just more benchmarking, so same set of stuff, now including some private markets benchmarks as well. Again, I think the message here is that long-term we've done quite well. We've done actually very well in growth equity and in special sits. We've done all right in the core buyout portfolio, and I think the good news is we've gotten better. We faced some long-term drag from Keystone Legacy, and I'll get to this just in a couple minutes, but when you look at the total we define as core portfolio, so excluding the pieces we moved into Keystone Legacy, the long-term performance is quite good, around 15%. So very happy with that. Okay, one more forward again, please. Really quick here, just a bridge what happened in the quarter, right? Contributions, distributions, gain loss. Your gain loss consistent with the broader market, really in sort of the 100-ish bips range for the quarter. Okay, one more forward, please. Okay, this is my favorite chart for the colorblind folks in the room because nobody can read it. So what we want, and I've said this before, but I'll say it again, is we want the dark blue bars on the left to be bigger than the dark gray bars all the way on the right. What the dark blue bars are your performance in any given funds by vintage year. That's IRR on top, multiple of capital on the bottom. The light gray bars are the top quartile for private markets and a composite benchmark. The dark gray bars are the median. There's 13 years on here. We've done a really good job in all but a couple of those years exceeding the median, and where you can exceed the median in private markets, there has been consistent performance relative to the public markets on a PME basis, even over the last couple of years. The issue that we face relative to public markets is we've got a portfolio of commitments that are not facing a low water mark. But if you look at 21, 22, 23, 24 vintage funds, you take median and you take top quartile, you do a public markets equivalent, you compare it to the public markets, there is persistent outperformance vintage year by vintage year, which should hopefully lead to good long-term results. And so what we want to see here again is good outperformance versus the median. We've done that, in particular in the most recent years, we've done it quite well. Let's move on to the next slide, please. This is just what I've said before, and just a refresher how we're pivoting exposure. All you should really try to read here, rather than all the numbers, is where is our unfunded capital relative to our total exposure. So the rightmost column, total exposure percentages, third in from that, from the right, percentages again is percent of the unfunded. What you'll see here is that we've got a bigger percent of our unfunded in North America, a little bit less in Europe relative to our total exposure. That's the pivot of the plan going forward, and it's been very intentional. Moving forward, one more. This is just the core portfolio thing I mentioned since inception. 15 net has done quite well, good multiples of capital and good consistent performance across strategies. And then these will be my last two slides, the next two. This is quarterly. What you want is the orange line to be above the bar. That means you're getting quarterly net inflows. And then one more for me, please, is just going to be the annual one. I've mentioned this before. This is actually a really impressive chart compared to broader universe, what we see in clients. Good, consistent, positive inflows for the plan year by year, just marginally negative in 2020, but a cash flow positive plan. 2025 is just the one quarter for what it's worth. But when you look at annualized, it's going to look a lot like 2024 on a year-to-date basis. So I'm going to stop there. Happy to answer any questions, talk about market. Otherwise, I will hand it off again to Kyle and the real estate folks.
Nobody accused Matt of slowing the meeting down, that's for sure. Thank you, Matt. That was a lot of information. Do we have a question? Treasurer Garrity, do you have your hand raised, I believe, virtually?
I do. So your page 6, I know the numbers are positive, but they're quite a bit below the benchmark.
Yep.
And why is that?
Sorry, let me just open it so I have it on my own computer. I think page 6 is the one that has, yeah, okay, so it's all of it. Look, I think within core buyout, we've done a lot of good larger market managers, and where you've seen that performance over the last few years has really been in the middle market, in particular in a environment where we've faced a increasing interest rates and slower growth, leading to a broader devaluation in the industry. There's been less impact in the small and middle markets. And so a lot of that benchmark performance, and I'm picking out buyout because I think that's part of the underperformance, and a big part of the underperformance here on a relative basis, is that small and middle market buyout performance is where we've seen a lot of alpha, where we've seen a lot of good consistent exits. And when I talk about yields, we've also seen a good amount of excess yield in those markets on a relative basis. What we've done is probably been in a little bit more upper end of the market. Long term, that should buy more stability. There's a more consistent band of outcomes there, but you have less absolute return, and you will face in these instances of dislocation probably a little bit of lagging return. I think when we look at the core growth equity and the core special sits, the manager selection has been quite good, and we've performed well. Keystone Legacy, we've talked about. I won't belabor the point here. A lot of smaller commitments, a lot of venture capital, a lot of emerging markets exposure. That is not what we're doing anymore. And I'm not surprised it's underperformed the benchmark given the quality of the funds in there. I think in buyout, one thing to think about, maybe to answer the question head on, Treasurer, is just, and we've tried to do this with Arcline last year with a few funds that are in the pipeline this year, is just focus in on really good, high quality, sort of what we call SMID as an industry term, small middle market industries there. And those are going to be fund size sort of in this $3 to $7 billion range. And we've spent a lot of time with the team just sort of talking about optionality there to create some more alpha and ride the upswing. Because I think that is the one sore area, and that impacts the total plan combined portfolio performance as well. If there's anything you want to add. That's good.
Does that answer your question, Treasurer?
It does. It seems like we try to pick and choose a little bit, but yeah, it does. Thanks.
Yeah. I think, and maybe I'll answer this very directly. I should take yes for an answer and take some advice on this, but I think we have looked at what happened at Keystone Legacy, which was a lot of very small exposure, a lot of very eclectic exposure, a lot of venture, a lot of emerging markets. And the reaction to that was, let's move up market and get less volatility. That has its time. It's led to good long-term consistent performance, but it also in these periods will lead to less absolute performance. I think trying to wiggle into the right balance here is the orientation. And I think that's the intention. You'll hear from us over the next couple of meetings, funds to match that.
Okay, thanks.
Okay, any other questions for Matt or Kyle on the program? Okay, if not, we'll switch asset classes to real estate and switch Matt's to Matt Ritter. You'll be coming up, joining us from NEPC. And Kyle, go ahead and introduce. We're at
6D.
6D1 is the presentation we'll be looking at. Okay, Kyle, go ahead. Thanks.
Great. So on the real estate front, the portfolio is currently sitting at 5.3% of the total fund versus a 7% target. We continue to move toward the strategy mix approved by the board in 2022. So in other words, moving away from lower returning core real estate strategies in favor of higher returning value add and opportunistic strategies. Related to that, after Matt presents the performance report, the next agenda item will be a recommendation for a commitment to an existing manager who is a bright spot in the real estate portfolio currently and pursues a value add strategy that fits SERS real estate mandate currently. But before we get to that, I'll turn it over to Matt and he'll walk us through the report.
Great. Thank you, Kyle. Good morning, everyone. Good to see you today.
As I've done in prior quarters, I'm going to go through a little bit of the performance update and the portfolio update on the SERS real estate portfolio. And I will also then touch briefly on the current market environment, just to kind of bring you a little bit more up to speed, since this is a Q1 report. Starting on page 2, the first real page of the report here, we show trailing time period performance for the SERS real estate portfolio, as well as the policy benchmark, which is the NCREIF Odyssey Index, and an index of open-end core real estate funds. As I think we're all aware, it has been a challenging period for real estate returns the last couple of years, and I've spoken about this the last couple of quarters that I've come in here to give you all these updates. But there is, some positive signs in the portfolio and positive signs in the market in terms of where we're headed, which I will come back to. I mentioned the Odyssey as the policy benchmark. You can see here that the Odyssey reported a modestly positive return of about 1.2% over the trailing 1-year period. So it's, again, a modestly positive return, but it is positive nonetheless. So a sign that we're moving in the right direction. And in fact, the total real estate portfolio for SERS generated a positive 1.4% return in the first quarter, compared to the Odyssey, which was up about 90 basis points. So certainly there's still ground to make up, as we look at some of these longer time periods, but nonetheless, I think, signs that we are moving in the right direction here. Or I should say the market is moving in the right direction. Turning ahead to the next slide, page 3. You've seen these before. They don't change much quarter over quarter, but it just gives you a sense of how the portfolio is allocated. As Kyle alluded to, we are in the slow-moving process of shifting this portfolio more towards some of the higher returning strategies, those being the value add and opportunistic funds. On the left-hand side, you can see that those are still value add opportunistic is still only about 45% or so of the portfolio. The good news, if you look at the right-hand side, is that a lot of that allocation is still in the investment period. So that light green bar or light green slice of the pie on the right-hand side, meaning these funds still have capital that is being deployed today in a favorable market environment. So putting new capital to work to generate good returns for the portfolio going forward. I think the ballpark is it's about $300 million or so of unfunded commitments in there. Next slide shows diversification a little bit of a different way by geography and property type. I think the punchline here is that the portfolio is highly diversified, certainly within the U.S., close to 20% outside the U.S., and then also by property type, as you can see on the right-hand side here. Again, another chart that doesn't change too much quarter over quarter. Turning ahead to slide 5, this is a similar chart to what you saw from StepStone a moment ago on the private equity side. But the point here is that the portfolio has been a very positive contributor. The real estate portfolio has been a very positive cash flow contributor to the overall portfolio. I think we've got 8 of the last 10 calendar years, and 2024 just barely missed out on being included here, that real estate was a positive cash flow contributor to SERS. You can see, however, that transaction volumes remain very muted in general. So 2024, not a lot of distributions or capital calls, and 25, while we're only showing 1 quarter here, also pretty small numbers. We expect that as the real estate market sort of unlocks and transaction volumes increase, we'd expect both of these bars to grow, but we would more importantly expect that the portfolio will sort of revert back to being that strong cash flow generator for you that it has been historically. So on slide 6, we look forward a little bit more to the future and sort of what we're thinking for the portfolio. As Kyle alluded to, we're going to continue to add to the value add and opportunistic portion of the portfolio. More on that in just a moment. But the key here is that we're looking for strategies that fit and complement the SERS portfolio well, and also are well positioned to take advantage of the current market environment. Turning ahead one more slide. So this is where I try to bring us a little bit more current. We've got a Q1 report and Q1 performance, but I'm sitting here on September 30th. So I'll keep this fairly high level, but certainly happy to answer any questions. As you've heard from me in prior quarters, the real estate market overall is actually pretty healthy. Now, the returns have not necessarily reflected that in the market, but that's really been driven more by capital market influences, whereas the real estate market, meaning things like occupancy, debt availability in the market, things like that have been pretty healthy for a couple of years now. In more recent quarters, performance has turned slightly positive, but there is still uncertainty in the market. And I think if we turn ahead to the next slide, I can just touch briefly on some of the strategies that NEPC is focused on and is working with SERS on in terms of where we think there are attractive opportunities today. There's a couple of areas I would highlight here. So in terms of the diversified opportunistic strategies, we think those types of strategies should be well positioned to take advantage of any inefficiency or distress in the markets. And then we also highlight here sector-specific funds, things like housing or industrial or data center strategies that have a lot of growth tailwinds. And then the last thing I would mention is strategies that have the ability to sort of be a provider of liquidity to the market is another area. Would be that debt or secondaries, an attractive place to be allocating capital as well. So with that, I will pause and see if there are any questions. Otherwise, I will turn it back to Jim, I guess.
Good. Thank you for that update. Any questions? Matt?
Could you talk a little bit more about, I guess, the market update and the market trends and kind of the different sectors? Are there sectors that are growing? Or is there certain sectors that are more worrisome? I'm just kind of more like that.
Yeah, absolutely. So in general, as I said, the real estate market is fairly healthy. Each sector and each sort of market geographically is of course going to be a little bit different. I think by far the biggest sort of outlier is going to be office. That has been the case, certainly since COVID hit, and it's really not changed. Office is, and in some quarters we include some of these charts in here. Unfortunately, not this quarter. I don't have anything to point you to. But office is the one outlier. If you look at things like occupancy rates, rent growth, cap rates, which is sort of the yield that different asset classes are demanding, in every chart, office is the outlier. If you look elsewhere, it's a much more, even if it's not a super bullish story, it is a stable story. I think the good thing about these last couple of years of having some uncertainty, higher interest rates, higher construction costs, has led to there being just limited new development across all property types. So you look at a sector like industrial, industrial has been a strong performer. It continues to be a strong performer, and it is helped by the fact that there's really been no new development in the last, or very limited new development in the last couple of years, given those dynamics. So I think when we look at housing, particularly sort of middle income and affordable housing dynamics, industrial, I mentioned data centers, as well as some other kind of offshoots of office, things like medical office are continuing to do quite well. I don't know if I'm sort of rambling here if I'm answering your question, but those are some of the sectors that we've been more constructive on. Certainly, there are some markets that you always want to look at the supply and demand by an individual market rather than paint with a broad brush, but just at a high level, that's sort of what we're seeing.
Thank you.
Sure.
Okay. Thank you. Mr. Faber.
Quick question on timing. All of this information is for the first quarter.
Yes.
Is there a reason we don't have a little bit more current information for the second quarter?
So the closed-end drawdown style funds, they're just are very slow to, and this is true for real estate, any private market, private equity. There's always a lag associated with the reporting. So we don't get like Q1 statements, for example, until well into the second quarter. So you always have a quarter of a lag. The open-ended funds are a little bit quicker, but but we always want to keep the report, everything uniform with the data that we have, fully checked and verified as of Q1 rather than provide kind of a mismatch. But fair question.
Yeah, the valuation process is manual intensive, labor intensive versus logging into a Yahoo Finance or Bloomberg or something and pulling up prices for any particular date you want. So it's part of the process with it is a diversifier for the portfolio, the private markets in general, which is helpful because we have a fairly large allocation to public markets, and the volatility comes along with the ability to look at the price every day and investors to make good decisions or react very quickly. Okay, if you have any other questions for Kyle or Matt on the real estate program? Okay, if not, we'll move on to the next section, which will involve Kyle and Matt. If you'll stay up there, and we'll bring Steve Belusha, our portfolio manager that handles private markets. Real estate is one of the asset classes. Steve and Matt Sechrist also is joining us from the team, ready to answer any questions. They conducted the diligence on this opportunity, and Kyle will give you some of the highlights here before we hear from Matt on portfolio fit. Matt Ritter, that is, from NEPC, and then finally from the manager themselves. This is an outstanding opportunity. That's all we're bringing into the board in these trying times for real estate. So go ahead, Kyle, and bring us up to date.
Sure. Yeah. Thanks.
Presentation is 6E1, I believe, the CIO slides.
Yep.
Okay.
We've got it up there. We can start on slide 3. So Steve's going to walk us through the slides that detail our recommendation to make a $100 million commitment to Blue Owl Fund 7. SERS has made a total of $525 million in commitments to Blue Owl going back to 2017, back to when they were called Oak Street. And the commitments to this fund series have been paying off, so generating a 15.1% return and a 1.3 times investment multiple. For Fund 7, they're going to continue to pursue the same strategy that offers a good amount of downside protection while still supporting the strong absolute and relative returns. And with that, I'll hand it over to Steve.
Thank you, Kyle. And good morning, ladies and gentlemen of the board. Jumping right in on slide 4 to discuss strategy. Blue Owl Real Estate Fund 7 continues the firm's proven North American net lease strategy, targeting mission-critical real estate assets, primarily in the industrial, data center, and essential retail sectors. These are properties that corporations rely on to operate their core businesses, making them resilient and high priority. Blue Owl serves as a solutions provider for these corporations, offering the ability to unlock balance sheet assets to support business objectives through a sale leaseback or developer takeout. And in exchange, fund investors receive favorable off-market pricing, triple net leased to investment-grade tenants. Since 2009, the strategy delivered stability, predictable income, and downside protection. That success stems from 3 key pillars: a focus on investment-grade tenants, long-term leases, and the triple net lease structure. For an overview of the triple net lease structure, please refer to slide 5. It compares Blue Owl's triple net lease strategy with a standard lease. In a triple net lease, tenants, not the landlords, cover operating expenses like property taxes, insurance, and maintenance. This structure helps mitigate inflation and expense risk. Additionally, Blue Owl's emphasis on investment-grade tenants enhances cash flow for liability, while long-term leases reduce vacancy risk and offer flexibility on asset sales. The result has been strong risk-adjusted returns across prior fund vintages, returns that SERS staff and consultant expect to continue with Fund 7. Slide 6 provides a closer look at performance. As you look at the table below, please note the light blue shading indicates funds in which SERS has invested. In aggregate, Blue Owl has delivered a 15.9% net IRR and a 1.3 times multiple across the fund series. Every fund ranks in the first quartile on a net IRR basis, and 4 out of 6 funds exceed the median for both TVPI and DPI respectively. Importantly, Blue Owl has a 0 realized loss ratio to date. While Fund 6 shows a slight accounting loss due to its position in the J-curve, This is expected to normalize as assets stabilize, consistent with prior funds. On a relative basis, Blue Owl outperforms the FTSE Nareit public benchmark across all funds, both individually and in aggregate, as shown by the strong PME and direct alpha metrics. In short, Blue Owl has delivered compelling risk-adjusted returns and has been a strong performer for SERS. On slide 7, we have a summary of the manager's ESG and DEI initiatives. Annually, Blue Owl produces a sustainability report, which can be found on their website, and tracks progress on those initiatives. The Blue Owl team will join us shortly and would be happy to address any questions you may have. Let's turn to slide 8 to discuss pacing. As a reminder, this proposed commitment of up to $100 million would be SERS' first real estate commitment this year. And moving to slide 9, just want to highlight that since our initial partnership in 2017, Blue Owl has remained a committed supporter for this board's transparency initiatives, an approach that will continue with Fund 7. That concludes my prepared remarks. If there are no questions, I'd like to invite Matt Ritter of NEPC to speak to portfolio fit, followed by a presentation by Blue Owl, led by Gary Rosier and Chris Gates. Thank you.
Great. Thank you, Steve. At the risk of reiterating some of the things Steve said or stealing the thunder of Blue Owl, I'll keep this fairly brief and just say, NEPC views this as really a great opportunity to re-up with an existing manager in the portfolio that has delivered strong returns for SERS, including a significant realized portion of returns. The strategy targets a 12 to 14% net IRR, placing it solidly in the value add and opportunistic bucket of the portfolio. So as Kyle mentioned earlier, this is something that will continue to help us get closer to those strategic targets of tilting a little bit more into the value add opportunistic side of things. From NEPC's perspective, Blue Owl is a really attractive all-weather type of strategy. NEPC has high conviction in this fund. We've placed a number of clients into it and expect additional clients to invest as well. It's a strategy that is resilient, as evidenced by its strong performance through market cycles. It's a generator of significant cash flow, which is also going to benefit the SERS portfolio. And lastly, as you've heard from Steve, they've shown a proven ability to generate strong returns, in many cases in excess of their targeted returns. So again, a lot to like about this, but we think it's a really good complement and addition to the SERS portfolio.
If there are no questions, we can bring in Blue Owl for their presentation. All right.
Okay, welcome. Thank you for making the trip and for the success you've delivered on previous funds. We're looking forward to continuing that. If you would introduce yourselves and then go ahead, keep your time allotment in mind here. We're pretty close on time. I think we want to keep that way, so thank you for that. And if you would kindly remind Shannon of what page number you're speaking to in particular. Thank you.
Hello, everyone. I am Chris Gates. Thank you for that. I'm Chris Gates. I'm one of the leaders of the institutional capital business for Blue Owl, and very pleased to be here with you today. Thank you.
Good morning, Jim. Good to see you, board. I appreciate the opportunity to be here. Gary Rosier. I serve as a senior member of our real estate team, member of the executive committee as well as the investment committee. I run our net lease real estate business day to day, so I'm involved in all aspects of our business. I want to say thanks to you all for bringing me back home. I'm a native of Pittsburgh, grew up on the south side, and I married a good girl from Lancaster County, just down in the Susquehanna here in Columbia. So great to be back in the Keystone. I appreciate that. This relationship obviously special to me for those reasons, but also because our real estate business was founded in 2009, but we've had a relationship with PA SERS going back to 2017, as I'm sure the team has walked you through. We've had 4 vintages together. Pleased to say that we've actually exceeded returns on all 4 of those. So should we be awarded this mandate, it will be number 5. So on behalf of all the Blue Owl, specifically our team in real estate, I want to say thank you for that. I'll start on page 3, if you have the slides up. I imagine our team has gone through this a little bit with you, but Blue Owl is a leading large alternative manager, publicly traded, based in New York City. We've got about $300 billion of AUM. Our real estate business, again, where I spend most of my time, is about $80 billion of AUM. And we are the largest player today within the what we call net lease space. And I'll walk you through what that means. Go one slide ahead again, number 5. Just give you a little background and something that I walked through before, but our first vintage was Fund 4 for us. That was 2017. And again, you can see the long history we've had together across these various vintages. PA SERS is also a founder in our first open-end fund as well, and remains one of our largest investors. So again, a lot of history here and what we're doing within real estate. Next slide. One more, page 7. Thank you. You'll hear me say net lease a lot. I'm sure you've heard it from the team as well, but net lease describes the type of real estate that we execute on, and put in layman's terms, net lease is effectively the type of agreement or lease structure with which we have with our tenants. So if I say that slowly, when we acquire real estate, we usually acquire it directly off the balance sheet of large publicly traded organizations, and we lease it right back to them. But that lease says they have to operate the asset plus pay all the operating expenses. So you think within real estate, the vast majority of your expenses will be things like taxes, maintenance, insurance, capital expenditures, and utilities. Well, the beauty of net lease is our tenant is responsible for paying all those expenses. So as owner of the asset, we have no exposure to any of the expenses. It's a beautiful inflation hedge, but it also gives you great clarity of your capital, because they pay all the expenses and we receive our cash flow net of all expenses. So when I say net lease, that's what we mean. And again, within the net lease space, we have about an 80% market share. First mover in 2009. Today, we're still the biggest player within net lease. Our investment strategy is really focused on providing downside protection first, and then very clear and consistent current cash flow. Tell you how we do that very quickly. So we own all single tenant assets, just like it sounds. We have one tenant in all of our buildings. We usually buy a diversified portfolio of assets. That means we may have industrial assets, retail assets, data center assets, and other. Other could be single tenant headquarters. Other could be healthcare. Other could be life sciences, or maybe even ground leases when we think it makes sense. So very diversified from that perspective. One of the most unique things that we do, and I think it's one of the most important things, is we will only transact with investment grade rated tenants. Okay, that's companies that are usually publicly traded, very large global operators, companies that you would know by name. So think of organizations like Oracle, Intel, CVS, 7-Eleven, BP, Schlumberger, again, A-class, very prestigious organizations that are inside our buildings. Why we do that, we think it lowers your risk of default, because these companies you expect to be around and live up to that lease, which says they have to pay all the operating expenses and then pay us rent. We're the only private equity real estate firm that has that limitation of only transacting with investment grade rated tenants. And over our history, 16 years, we've only had 5 defaults, having worked with over 300 tenants. So I think our record on that is pretty good. We also structure long duration leases, usually target 15 years. We add rent escalation into those leases as well. Why that's important is because it means our net operating income or cash flow from that asset goes up 2% every year, no matter what happens with the expenses. We also structure pricing that is a minimum of what we can pay and a cap of what we can buy, right? So we measure pricing with something called a cap rate. Cap rate is just your unlevered yield from the asset. We set a minimum of 7%. That means we will never overpay for an asset. It's very important, having gone through what we just went through in real estate the last 3 or 4 years. We know assets underwater because we are very stringent about what we pay for assets. So that 7% cap rate limitation is something that most people strive for. We actually put it in our limited partnership agreement. So I could love an asset. If it's below a 7 cap, we can't buy it. So very structured pricing as well. Now we do all of that very stringent investment criteria, so we can pay you an 8% annualized yield that comes every single month. And for 180 months now, we've never missed a monthly payment. So that's cash flow that comes back to you every single month from the real estate that we own. You can slide forward for me just another page. One more, sorry. Oftentimes, people that will sit here in my seat, I guess they tell you what they do. Oftentimes, they don't tell you why they do it. So I'm going to give 30 seconds on the why. So why triple net leases? Simply put, it mitigates your expense risk, right, and provides great clarity of cash flow. So very important why we structure our leases that way. Why investment grade? Lowers your risk of default. As I mentioned before, 5 defaults in 16 years with over 300 tenants. Very strong record on that side. And why long duration or long-term leases? Our perspective is if you can fortify your cash flows, you want to do that for a long period of time, right? So steady cash flows coming back to PA SERS on a regular basis because we structure long duration leases. So that's the why. One page forward for me. Fun part of my job is how we source our transactions. This is the most non-real estate thing I'm going to tell you for a real estate manager, but follow me on that. We think of our transactions really as serving as a capital provider to these corporations. So unlike a lot of our peers within real estate, we're not just looking in the open or broker market at what real estate's available and then bidding on that asset like everybody else. I think that's a race to the bottom on pricing. Our perspective is we think companies, particularly prestigious companies like a BP or a Cisco or an Amazon or Oracle, they have a better use of their capital than to have it tied up in real estate, which is a non-earning asset that sits on their balance sheet, and they get no credit for it from the street. So our perspective is let us own your real estate. You take the value of that asset in your hand today so you can put it back into your great operating business where you actually generate capital. So our sourcing is us going directly to these companies off market, whether they've thought about selling the real estate or not. We present that solution of us being the owner of their real estate so they can better utilize that capital. That is a different way of sourcing real estate transactions. The way I look at it, we're really a provider of capital to these corporations, and the real estate is our horse or our currency to get that transaction done. One slide forward. You may ask yourself, why would a company as prestigious as an Amazon or an Oracle have you own their real estate and not own it themselves? There could be a number of reasons, and I won't go through all of these on this page, but these are the 5 main reasons we tend to see companies look to sell their real estate. Right? They could have an M&A strategy they want to execute on. Well, we can be their source of capital for that acquisition, again, through the monetization of the real estate. They can then use the proceeds to buy the next company. Right? It could be a CapEx solution partner. When Amazon wants to build brand new fulfillment centers, they oftentimes don't want to utilize their own capital because they don't get paid for it. We can use the capital through owning the asset and providing, whatever they need in terms of value to build the asset. Right? That's our relationship with Amazon, so on and so forth. So again, our strategy as a real estate team, again, is not waiting for those companies to decide they want to sell the real estate and then put it out to bid. Again, it's a race to the bottom. We're usually going directly to them off market with the solution and saying, we think you have a better use of your capital. We can be your partner. Here's how we're going to get it done through owning your real estate. Why this matters, while it's fun for me and fun for our team every day to be able to do that, why it matters is because if companies look at you as a capital provider and a partner, they're going to give you those assets at a far better pricing. So historically, 16 years worth, we've bought our real estate at a 22% discount relative to where our peers buy those same assets in the broker market. That's the most important thing. One that gives you great downside protection because, well, my basis is lower, right? Imagine buying $1 million building for $800,000. You're going to feel pretty good about your downside there, right? But then we can also sell back to the brokered market at that broker price. So when you see our returns, historically, that's where it comes from. Slide 4, one page for me. This is the outcome here in terms of our returns. As I mentioned before, I'll start at the top of the page. The 2 numbers that stick out to me is our preferred return, that 8%. Our strategy structure to pay that 8%, it's an annualized number, but again, we pay it every single month, right? So that is current cash flow that you receive from the strategy itself. We've done this now every single month since our history. So you're showing 186 on the page today. It's actually a little behind. I think we're on month 189 of cash flow. Never, not once, miss a monthly payment. That includes the COVID months. Right. So through COVID, we paid every single month because we collected rent from every tenant on time every single month. The only private equity real estate firm that can say that. And again, that's the cash flow that we use to pay you all. Performance wise, again, PA SERS came in Fund 4. You can see the returns there, net 17 IRR. That greatly exceeds our target return of a net 12 to 14. And we still have 25% of that portfolio to sell. So I imagine we're going to end up in the net 20s like we have in the previous 3 funds. Fund 5, which are also sitting at a net 13. We've only sold 25% of that portfolio, which means we have 75% left to sell. So I imagine our returns will also fall in line. And then Fund 6, we're still in the investment period, so we don't have the numbers up. But what I can tell you is we are sitting at a net 15 IRR. Again, all of these exceeding our target returns of a net 12 to 14 while paying you that 8% annualized yield in person. So I'm going to pause there. Happy to open up for questions if there are any, but I'll just say thanks again for the trust in Blue Owl Real Estate. Thanks for bringing a Pittsburgh kid back home, and I hope we're awarded this fifth fund.
Fantastic. Any questions for Gary and the team? And just for clarifications, how many of the companies actually buy their own property back, or do you go to the open market when you liquidate?
Almost never. I can count on one hand, how many times they brought their real estate back. I always say, if we've done our job and explain to them why they shouldn't own real estate, they usually don't buy it back. So we usually sell to a third party that is not the company. However, we almost always give the corporations a first right. So if they do want to buy it back, we'll give them a first right. However, they have to buy it back at a market price.
And then is there a tax motivation for those companies to enter into a transaction with you?
It's actually one of the main reasons why they will sell their real estate, because it's actually it's a very big advantage from a tax perspective. And without giving you tax advice, because I'll get in trouble for that, I'll give you the quick summary as to why that is. Companies that own real estate, they're limited to how much of their interest they can deduct. Okay, so it's 25% of EBITDA, right? Real estate that you lease, fully deductible. So you can lower your tax burden overnight just by selling your real estate and leasing your real estate.
Fantastic. Thank you for that clarification.
Thank you.
And anybody else? I don't see any hands up. Treasurer Garrity, I see you, but no questions? Okay. That means you did a good job. Very good. Awesome. Thank you very much.
Thank you. Thank you.
All right. Kyle and Steve are here if you have any other questions about the opportunity or anything to do with real estate at all. If not, Chair Monson, I'll turn it back to you to work on the motion. Thank you.
Are there any other questions from anyone for the folks who are here? Yes.
The presentation was very solid. I'm just curious, why was the number 100 million? Why that number? Why not higher? Why not lower? Why that number?
Historically, we've targeted larger opportunities, and 100 million for us is a larger opportunity. Previously, many years ago, we've gone as low as 15, 20 million, and that requires as much labor and, staff time and everything with the consultants and us. So we've moved towards making larger opportunities. And historically, we would commit 2, 3 to 4 funds a year, and having $100 million it helps us manage the risk across multiple funds. But we're only making one commitment pretty much, so far this year. But that's why we do 100 million, is to keep it meaningful, to manage the risk if we did multiple funds, and also manage time of managing a fund. Whether it's 20 million commitment or 100 million, it requires the same amount of time for due diligence, ongoing diligence.
Yeah, and as an example, when I joined 10 years ago, the first meeting I came to, there were 5 private equity opportunities ranging as low as 20 million per, and just massive amount of labor required on the consultant and the staff. So we migrated towards fewer, larger deals because we have the size. We can negotiate better terms.
That's true.
As you see in the executive session, the fees we don't cover in public session. We'd have to go to private, but it's there for your convenience to see the negotiated fee terms. Going with larger deals, you have more of an opportunity to negotiate better fees, of which this team is very focused on and successfully did that for this opportunity. Good question, though. Thank you. Any other questions? All right, Ori.
All right, seeing none, I'd like to ask, do I have a motion to recommend that the State Employees Retirement Board commit up to $100 million to Blue Owl Real Estate Fund 7 LP, plus investment expenses and pro rata share of partnership operating expenses, consistent with executed partnership documents as a follow-on investment within the real estate asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months.
So moved.
Is there a second?
Second.
Secretary Garrity, I think, seconded it. It's been moved and seconded. Are there any additional questions on the motion? Seeing none, I'll ask for a roll call vote.
Secretary Munson.
Aye.
Mr. Enders.
Aye.
Mr. Faber.
Aye.
Mr. McCary, on behalf of Representative Franklin.
Aye.
Mr. Galuska.
Aye.
Treasurer Garrity.
Aye.
Mr. Lindsay, on behalf of Senator Hughes.
Aye.
Representative Miller.
Aye.
Ms. Buchanan, on behalf of Senator Robinson.
Aye.
Mr. Soderstedt, on behalf of Secretary Spiker.
Aye.
Motion passes. Thank you all very much. And we can move to the next item on the agenda, which is a private equity opportunity.
Thank you, Chair Monson. Okay, we're going to switch our presenters here. Kyle will stay with us. Matt Roach comes back from Stepstone, and we introduce two of our private equity investment professionals, Destiny Julo, thank you for making the trip in, and Steve Shank. They worked tirelessly on this opportunity. We're going to take a look at what they have to share with us. Again, they negotiated good terms for SERS on this opportunity. If you move into Board Docs 6F1, you'll see the CIO introduction slide, which Kyle will cover for Matt Roach does the portfolio fit, and we ultimately bring HarborVest in to share how they execute the opportunities. And with that, Kyle, please take it away.
Great. So when we get the presentation loaded at 6F1, we can start on slide 3. This item is a recommendation for a combined $150 million commitment to a private equity secondary strategy run by HarborVest. So as you may know, SERS has a relationship with HarborVest going back almost 30 years. Most of our current investments with HarborVest are in a co-invest program that they manage for SERS. But we've also successfully participated in this secondary strategy at various points throughout our relationship with them. The recommended commitment will be structured as a $100 million commitment to the main Dover Street 12 fund and a $50 million commitment to their sidecar fund that will invest alongside the main fund. So at a high level, what we'd expect from a commitment to this strategy are strong absolute returns that are especially attractive on a risk-adjusted basis, as well as a very good portfolio fit for SERS. And Steve is going to walk us through the opportunity in more detail.
All right. Thank you, Kyle. Just wanted to double down on that third bullet point there. So SERS already has a long-standing relationship with HarborVest. We've allocated over $1 billion across 12 funds. That's going back to 1997. So to touch base on that, in the next part down, you'll see that our most recent commitment to Dover Street Family was in 2020. That was a $20 million allocation as part of the $200 million commitment we made to the HarborVest PA co-investment fund. Our initial Dover Street Family commitment goes back to 2008. That's Dover Street 7. So we're familiar with the strategy. On that note, moving on to strategy, commitment to, I'm sorry, if we move on to the next slide, thank you. A commitment to Dover Street 12 secondary fund will further diversify our existing portfolio. SERS has been making larger commitments, but less frequent commitments. So again, just to touch base on what Matt alluded to during the performance update, we've been making larger allocations, right? Dover Street Fund 12 will continue the existing strategy where they're investing in both LP-led and GP-led transactions. So I just wanted to pause there, elaborate further on both of those two types of secondary transactions. An LP-led transaction occurs when limited partners are selling stakes in their funds to third-party buyers. Multiple reasons for that. It's a common form of portfolio management, might come down to achieving more liquidity. Maybe they're looking to rebalance their portfolio, whether it be by strategy. Sometimes it's just a matter of just reducing the unfunded commitment. Maybe more times than not, it's probably checking multiple boxes I just mentioned there. So in contrast to that, you also have GP-led transactions. Obviously, they're initiated by the GP, but they're typically more complex in nature.
They might involve restructuring funds or retaining particular assets for the purpose of essentially extending their value creation period. And then on the next point there, majority of the portfolio is going to remain comprised of buyout assets like previous funds, and North America will remain the largest allocation geographically for Dover Street 12. On the next slide, we're looking at secondary funds versus primary funds. With SERS typically committing to primary funds, we want to just provide some visuals here. Following charts highlight key differentiators with respect to performance and cash flow measures between a secondary fund and a primary fund. So a couple takeaways. Each of these charts will illustrate higher returns as well as earlier distributions for a secondary fund versus a primary fund. Key point there is that this is primarily driven by the fact that the secondary fund is buying more mature assets, and that's what's driving that. Next, I'm going to transition over to Destiny, and she's going to cover performance.
Thank you, Steve, and good morning, everyone. Looking at Dover Street's performance going all the way back to 1991, we see that Harbor.
Are we
on?
Are we on? We good?
No, we're
Okay,
not on.
sorry.
Perfect. Thank you, Steve. Looking back, going all the way back to 1991, the inception of the Dover Street funds, HarborVest has consistently generated double-digit returns with meaningfully lower risk compared to primary private equity buyout commitments. I think where Dover Street stands out the most here is the differences it does have versus primary fund commitments and the reduced risks represented here. Steve highlighted a few of these differences. I'm going to expand a little bit further. One of them being the low loss ratio for Dover Street. We see a composite loss ratio at the bottom of that table there of only 2%. This is meaningfully lower than the historical double-digit loss ratio we see for primary funds. Dover Street will be buying, as Steve mentioned, these more mature existing assets and funds that are closer to exit. This not only reduces the J-curve effect, but it also reduces blind pool risk altogether, assisting and leading to a lower loss ratio. In terms of blind pool risk, primary funds take on more risk investing in these younger companies with more risks and uncertain outcomes, while Dover Street, again, buying these existing stakes in assets, existing stakes in funds with established portfolios. This will allow the Dover Street team to have more transparency, a better understanding, and more visibility into the underlying assets that they're purchasing. With Dover Street investing in these more mature assets, it also assists in reducing the J-curve. The J-curve describes in private equity funds showing negative or lower returns in the early stages before eventually becoming more profitable, where secondary investments, on the other hand, given that they are acquiring assets that are more mature later in their life, this typically reduces that early period of negative returns and typically leads to realizing returns sooner. And when putting all of this together, seeing Dover Street consistently generating double-digit returns and seeing that they are benefiting from these reduced risks of simply being a secondary fund, we do see their track record as being attractive both on an absolute basis and a risk-adjusted basis. And moving to slide 7, we're going to slightly touch on the performance of the secondary overflow vehicle. Just as a reminder, this is the overflow vehicle investing alongside Dover Street 12. We can view this in a way similar to a sidecar. And looking at the performance, inception of the vehicle going back to 2012, they've consistently generated double-digit returns, and with this fund with little to no losses. And looking back, we see performance for all previous funds sitting above median versus their primary peers. Moving on to slide 8. Moving away from performance and quickly touching on HarborVest DEI and ESG initiatives, HarborVest annually releases both a DEI report and an ESG report, highlighting the continued progress that they've made in both areas. And moving to slide 9, quick highlight on pacing, apologize, a little small. We wanted to highlight Dover Street 12 would be our second commitment in private equity in 2025, if approved. And at the table in the bottom, we do see our recent commitment activity, including Arcline. This was our first commitment made in 2025. This was just approved at the April board meeting. And the table also includes our co-investment SMAs, whose commitments are approved in prior years, but a portion of that commitment is used in subsequent years. And moving to slide 10, last but not least, is the transparency checklist. Our staff understands how much this means to both our board and our stakeholders, so we put a big importance here. HarborVest being a partner going all the way back to 1997, they continue to understand how important this is to all of us. Therefore, they've continued to agree to all the items on our transparency checklist. And I believe that wraps up our presentation. I'll pass it over to Matt at Stepstone to wrap us up with portfolio fit.
Yeah, just a couple quick thoughts as I was sitting here, maybe three things. One, it's a good time in the market to be doing secondaries, both for sellers and particularly for buyers. We've got some data that suggests that the secondary market in private equity last year provided about a third of all distributions that occurred in the industry, and has a lot to do with that depressed distribution environment that I mentioned earlier. So a very good time to be a buyer in providing liquidity to folks that are otherwise used to a lot of liquidity. Two, specific to this plan and fit, we have intentionally been a little bit under the modeled pacing targets for the last few years. A secondary fund by design, as Destiny and Steve just laid out here, will buy mature funds and mature assets, those being funds and assets in the main, relatively sort of 3 to 7 years old. And so we'll go and backfill some of those vintage year commitments right there. And then three, and perhaps most importantly, these guys are good at what they do. And so I think if you believe those first two things, you've got a good manager in front of you for a presentation right here.
Fantastic. And now we'll bring in the HarborVest team. Kyle, correct?
Yeah, if no questions, they're ready to go.
Okay. Right. And again, the importance, as Destiny just covered on these secondaries, it's a diversifier for us. You're not seeing the type of projected returns that you would in a pure private equity opportunity, but as Destiny pointed out, this is a lower risk strategy, a mitigation to the J curve, meaning money comes back sooner to the system. That's a de-risking mechanism where once you get your capital back, by definition, you can't lose money on that opportunity. So the quicker we get that money back, the better. So that's an important aspect of the secondary market. So thank you for making the trip, HarborVest. And if you would introduce yourselves, and please be mindful of indicating the page number you're on for our slide master over here, and try to stick to the timeline. Appreciate it.
Great.
Take it away. Thanks.
Absolutely. All right, if I put some glasses on. So these pages are pretty small here, so excuse the glasses here, getting old. Why don't we just start on page 2 then?
Could you introduce yourselves, please?
Yep, I'll do that right now. So my name's Nate Bishop. I'm a managing director at HarborVest. I've been with the firm since 2008. I'm based in our Boston office. I'm one of the senior partners on the global investor relations team, and I work with several strategic clients like yourselves. Today we work with you guys on a custom solution around co-investment. Today we're here to talk about our secondary program. In the interest of time, I'll introduce my colleague, Mike Pugach. Mike joined the firm over 20 years ago. He's one of the senior partners on our secondary investment team. So Mike balances time both across traditional and complex secondary transactions, but he's also been instrumental in shaping our approach to GP-led solutions, which is one of the fastest growing parts of the secondary market today. So before we dive into the specifics of Dover 12, I'm going to provide you just with a high-level overview of the HarborVest platform, our global scale, and our commitment to culture and community. I want to move to page 5. So HarborVest is a global private markets investment firm, and we've been managing capital for over 4 decades now and manage roughly $150 billion across multiple strategies. Sure. Wasn't bothering me. No. Thank you very much. Gotcha. Again, so today we bring deep expertise across 3 areas: private equity, private credit, and real assets. And we do that across 3 different strategies, both primary investments, secondaries, which are, again, we're here to talk to you today about, and direct co-investments. Our global team today is over 200 investment professionals, and we hold nearly 1,000 advisory board seats across the private equity spectrum. And this really reflects our rooted presence across the private equity ecosystem. Our managing directors average decades of industry experience, and we maintain a strong track record of both performance and partnership. Let's move to page 6. This gives you a sense of where we operate. So we have 14 offices worldwide. including recent expansions in Singapore, Frankfurt, and Zurich. Our main headquarters is in Boston, and this global footprint allows us to really source and execute deals across multiple geographies with that important local insight and ability to execute with speed. You can see here on page 6 also just gives you a good sense of how and where we're investing and committing capital across different strategies and geographies. And this scale and diversification allows us to deliver customized solutions both to the general partners that we work with and the clients that we serve on an institutional scale. And then last in this section on page 7, at HarborVest, we certainly believe that culture drives performance. So we're recently recognized in the Equality Group's Inclusive Top 20 Private Equity and Venture Capital Index, which evaluates firms on inclusion, diversity, and equity across 400 global firms. You can see our values are anchored in 6 pillars listed here today. And we also emphasize community engagement. So we ensure our impact extends beyond the firm. And these principles guide how we hire, how we develop talent, and how we engage with our partners. So with that context in place, I'm going to turn it over to Mike, who's going to walk you through the Dover 12 investment strategy and how it builds on our legacy of innovation and performance within that secondary market.
All right, perfect. Thanks, Nate, and thank you all for having us here today. So I'm going to spend a couple of minutes maybe just on the case for secondaries within a private equity portfolio for LPs, a little bit about the market opportunity as we see it, why we're so excited about that today, before wrapping up on our strategy, track record, and plans for Dover 12. So maybe first, and if we could flip to page 9, so maybe first a little bit on sort of the role of secondaries for LPs, and really think about secondaries as a strategy for being able to really acquire diversified private equity exposure from both existing limited partners as well as general partners in a partnership context, which I'll get into more detail on in a moment. But really buying into those mature private equity assets, really sort of in the heart of their value creation curve. So if you think about a typical 10-year life cycle of a private equity fund, really focused on buying assets that are between 5 and 7 years old on average, that have gone through their J curve or at the the front end or in the heart of that, and a strong go-forward value creation opportunity. So again, known assets in a diversified strategy, and certainly businesses that are closer to liquidity on the other end. What that results in is really some of the benefits that you see on the left-hand side of the page here, both from a J curve mitigation standpoint. So again, we're buying assets typically at a discount to their the stated net asset value or intrinsic value of those assets. Again, more mature businesses that are through the J curve already, but really mitigating any of that early fee drag associated with typical private equity investments. Again, buying exposure to a mature portfolio, really sort of seasoned assets, broadly diversified, where we're able to capitalize on both market dislocations, but also some of the trends and growth in the market that I'll get into. And then ultimately, a secondary strategy really providing LPs with a sort of compelling return opportunity for what we believe is lower risk. And I'll get into more detail on that in a moment as well. So if we flip to the next slide, why are we so excited about the market opportunity today? And what you can see here is really some very strong growth within the secondary market over a long period of time now, culminating last year in what was an all-time record year from an industry deal volume standpoint. I would say based on year-to-date activity in 2025, some of what we anticipate will get done before year-end, including in our own pipeline. I think 2025 is set up to be another record year in terms of industry volumes within the secondary market at kind of in and around $200 billion of activity. I'd say that's really driven by both what is an all-time high of private equity net asset value, just continued growth in the asset class has resulted in nearly $7.5 trillion of private equity NAV that sits across the balance sheets of institutional investors and general partners across the globe, but really kind of underpinned as well by growth, speaking specifically to the secondary market, growth in both the LP-led part of the secondary market, where we transact with institutional counterparties, so think pension funds, endowments, foundations, who are in need of liquidity across their portfolio or looking to just reduce their overall exposure to the asset class. So we transact in that part of the market. But we've also, for a long time, been a leader in what we refer to as the GP-led part of the secondary market. So where we partner with existing private equity sponsors, general partners that we know very well across our own ecosystem and platform at HarborVest, to provide really bespoke liquidity solutions for their funds, their portfolio companies in a partnership-oriented context, but importantly, provide liquidity back to limited partners. And so both of those are fast-growing parts of the market, underpinned by a number of strong trends, and certainly a core part of our strategy that we'll get into in more detail in a moment here. Maybe turning to the next slide, I mentioned a moment ago the sort of attractive risk-reward profile of secondaries as a whole. And what we try to highlight here is some industry data, which really shows on the left-hand side here. This is looking back across the industry historically, that roughly 15% of all private equity funds globally have actually lost money for investors. If you look at that entire data set across the industry, compare that against, in the dark blue, less than 2% of secondary funds across the industry historically that have lost capital for investors. So much lower downside risk with a secondary strategy compared to broad private equity. The corollary to that you would expect would be lower returns as a result of that lower risk. And interestingly, the data on the right-hand side, certainly from an IRR perspective, would suggest that not only is there a tighter dispersion of returns within a secondary strategy compared to global private equity, but actually very commensurate returns at the top end, or top quartile performance, and actually meaningfully better performance as you sort of move down within those bands with the secondary strategy versus broad private equity. So that really sets up for, again, in our view, what is a very compelling risk reward profile for investors in secondaries. So I'll pivot now maybe to talk a little bit about our strategy. And if we can go one more slide here to page 13, and just spend a couple of moments here. So the way we think about our strategy at HarborVest within the secondary market, really focused on buying, we consider high quality assets, partnering with best-in-class general partners, ultimately with a goal of seeing the entirety of the market. And so our sourcing and origination efforts are set up to see nearly 100% of the market, but be highly selective around what opportunities we go after within that, focusing on where we think there's the most attractive return opportunity. And then really playing in a part of the market where we can bring our size and scale of our capital to the table is really a competitive advantage. And that's, we use that from a competitive advantage standpoint relative to our peers. And we think that the benefit of that scaled capital that we bring to the table is a benefit to our LPs, because we're able to structure at price and ultimately set terms that we think are more attractive than the broader market as a result of that scale that we're able to provide. We do that across both the LP and the GP-led part of the market. Our strategy is designed to be roughly 50-50 between those two parts of the market. I would say it will range at any point in time 60-40 in one direction or the other, but that's sort of an intentional strategy and design for us, really, as we think about the opportunity to focus on where we think the most attractive opportunities are at any point in the cycle and relative to the broader opportunity set that exists out there. And then if we flip one more to page 14, in terms of some of our specific competitive advantages, there's a lot on the page here. I'll maybe sum it up with really sort of three distinct advantages that we think we have at HarborVest. So first is the experience of our team. So we've been investing in secondaries at HarborVest for nearly 40 years now. We've developed I think a great track record we'll get into in a moment here, but importantly, a significant amount of expertise in the industry. We also have a very stable team. So one of the largest secondary teams in the market, close to 70 individuals dedicated just on our secondary investment activities, but importantly, a senior team that has been together for a long time. And if you look over the entirety of our history, apart from the retirement of two of the original co-founders of HarborVest who helped to set up the secondary business back in the late 1980s, we've had exactly zero turnover at the managing director level over our history. And so the team that built the track record, built the strategy, is the team that's investing still today. We're very proud of that as we think about the benefit that brings to investors. Second, I would say the HarborVest platform globally. So in addition to having a strong secondary team, really industry-leading secondary team, we have the benefit of what is over 225 global investment professionals across our primary funds team, our equity co-invest and credit team. But what that really allows us is just more touch points in the market. So we have investment professionals at HarborVest that every day are speaking with general partners, with institutional limited partners that could be counterparties for us, helping to source and originate opportunities and helping from a diligence perspective with the deals that we pursue as well. And I think given that and given the breadth of the HarborVest platform, the deep relationships that we have with GPs, the fact that we've been investing with many of these private equity managers for decades at this point just gives us differentiated insights, differentiated access relative to many of our secondary only peers in the industry. And then lastly, I'll just mention data. We have a very robust internal database system, 40 years worth of private markets data, tens of thousands of companies that are tracked within that. And we use that data to our advantage as we diligence opportunities, as we look for trends, integrated analyses into our investment committee and decision-making processes, really, and an integrated approach with what is a nearly 30-person quantitative investment sciences team that helps to sort of harness that data that we have and use that in the context of our diligence and decision-making processes. So lastly, just touch quickly on our track record. If we could flip one more slide here, please. And as I mentioned before, the current team that's investing the Dover Street funds, really the team that built the track record that you see on the page here. These are results that we're proud of, both on an absolute and relative basis. And I would say in terms of our intentions with Dover Street 12, the new fund that we're here to discuss today, it's really a continuation of what we've done for a long time within the HarborVest secondary platform. Certainly what we've done across the last 4 Dover Street funds that you see listed on the page here. Same strategy, same team, intention to continue to execute in the same way to build a diversified portfolio of private equity secondary interests, predominantly buyout oriented, predominantly North America, Western Europe, and really targeting that 50-50 split between the LP and GP led parts of the market, both of which we think have some really attractive tailwinds associated with it. So I'll sort of conclude my comments there. We certainly thank you for the historic partnership and consideration around Dover 12, and happy to address any questions that anyone may have.
Fantastic. Any questions for the HarborVest team? Again, must have done a nice job. Covered everything. And there's more material in board docs. Obviously, we don't talk about the fees in public session, but they stepped up to their plate. Our team worked hard diligencing opportunities this year, and fees came into concern as well as all the other good things you heard here. And we were granted enhanced opportunity here from a pricing perspective as well. So thank you for that. And then if there's no questions, I don't see any hands up virtually. Okay. Very good. Thank you for making the trip. And then I'll turn it back to Chair Monson, if you would, for a motion.
Thank you.
Thank you for the presentations. Having heard no more questions, I'd like to ask, do I have a motion to recommend that the State Employees Retirement Board commit up to $100 million to Dover Street 12 LP and second up to $50 million to Secondary Overflow Fund 6A LP, a sidecar vehicle that will co-invest alongside Dover Street 12 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as investments within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months.
So moved.
Is there a second?
Second.
It's been moved and seconded. Are there any questions on the motion? Seeing none, I'll ask for a roll call vote, please.
Secretary Munson,
Aye.
Mr. Enders,
Aye.
Mr. Faber,
Aye.
Mr. McCary on behalf of Representative Frankel,
Aye.
Mr. Galuska,
Aye.
Treasurer Garrity,
Aye.
Mr. Lindsay on behalf of Senator Hughes,
Aye.
Representative Miller,
Aye.
Ms. Buchanan on behalf of Senator Robinson.
Aye.
Thank you. Mr. Soderstedt on behalf of Secretary Spiker.
Aye.
Thank you. Motion passes. Appreciate again everyone's patience and attention. I know we've already been here for a while. And I think the next item on the agenda is the educational session.
Thank you, Chair Monson. Yeah, in 6G1 in board docs, you'll find a extensive presentation by RVK. We're pretty close on time here, so we want to keep it that way, of course, RVK team. But this is a necessary exercise that we go through, and we thought it'd be a great opportunity for board members to pick up educational credits. So you will be getting credits for this. Compliments of Sheila and the team. And RVK team, if you will take it away to discuss the assets and liabilities or the various components of the plan, not just the investment policy statement. We're taking benefit policy, et cetera, into account as well, which you'll hear from the team. So thank you for that. Take her away.
Thank you. Thank you, Jim. The reason that AL studies are required at almost every pension plan is that they are uniquely a window into the prospective health of the plan. We call them the gold standard. It may be the most important analysis that gets presented to a board of trustees overseeing a pension plan. Boards don't invest without a purpose. Every institutional portfolio has a purpose. So you can't analyze and evaluate an investment plan without asking how well does it serve its purpose. That's what an AL study does. And it is the only type of study that can comprehensively analyze whether or not the investment strategy is matched to the purpose of the fund, which in the case of this situation are the benefits that have been promised by the legislature to public employees. And why do we care? Or why is it the gold standard? Because it integrates all the drivers of pension plan outcomes. The contribution policy, which is given, the benefit policy, which is given, and the investment strategy, which you get to choose. And that there's no other study, no asset allocation study, no asset class structure study, nothing that is as comprehensive as this. And the other is the consequences of a bad match can be catastrophic. These are the reasons why banks fail and insurance companies fail, because they have a bad AL match. And in the case of a pension plan, a bad AL match can cost billions over the next 20 years in terms of additional contributions. So this is why asset liability studies are virtually required everywhere, because they are unique and they are powerful and they address things of great consequence. So with that, I'm going to turn it over to my partner, Tony.
Great. Thank you, Jim. I'll start on page 7 of our presentation. Just as background, the study uses the actuarial data that was provided to us by your actuary, Korn Ferry. That data is as of the last evaluation report, which is December 31, 2024. I intend to walk through key pages of the study given the time constraint, but I will give you the conclusion of the study was that we concluded that the plan as it's currently structured is headed on a pretty good direction. You're currently at 68% funded, and based on the deterministic assumptions made by your actuary, and by that I mean every year they are expecting that the contribution policy will be held and maintained. Every year they expect this pension fund to earn 6.875% year over year going forward. Based on those assumptions, this plan is projected to improve its funded status over the next 20 plus years. The first 14 years, it's kind of a bit slower, but then the last half of that, it actually does accelerate pretty well to getting to 99% funded over the 20-year period in which we are doing our study. The one thing that we will note, and I'll note this on certain pages, is that there is a point in the future in which we would tell you that there could be a point at which there could be some stress on the assets of the portfolio. That stress gets back to the questions that were asked earlier about how much liquidity should we have available in our portfolio, meaning how much should we have in liquid assets, how much should we have in illiquid assets. The other gets to, and that gets to pacing. The question became the question you asked earlier, why 100 is the number that we're putting forward. In the future, we could come back and tell you, you may have to measure what that actual allocation is to alternatives, meaning your pacing may have to be reduced because of certain cash flow constraints that may occur within the pension fund because of what we're going to talk about in just a moment. Any comments before I move forward? Let's move forward to page 10. When I talk about the cash flow, this shows you the projected contributions over the next 20 years. The beginning part shows you both the employer and employee contributions. Clearly, the employer contribution outweighs the employee contribution. But what you also notice is, as you get to 2028 or 2038 and forward, the contributions start to fall. The earlier part of the study shows you the increased contributions as a result of the 2008 Great Financial Crisis. You, like every other pension fund, suffered some pretty significant losses. As a result, you had to increase your contributions. The federal government came back and stated you don't have to give the entire contribution up front. Rather, you can amortize that over a 30-year period. And so you're seeing the results of increased contributions going through 2038. And when that 30-year period falls off, your contributions fall back to a more normalized level. Why is that important? It's important because as it stands today, 70% of your benefit payments that go out every year is actually covered by the contribution. The rest is covered by the assets in the portfolio. And because of that great balance of the contributions covering many of your benefits, your assets are allowed to grow over those years. So over these years, you would expect to see great growth of the assets allowing the contributions to cover the bulk of what goes out for benefit payments. The challenge that we're seeing is that once the contributions start to normalize after 2038, it's now going to be incumbent upon the assets to pick up the responsibility of making sure the assets are available to pay benefits, getting back to how much liquidity should we have. That's important. Although you're seeing the growth over time, that strain on that liquidity is what's going to come back and tell you that it could perhaps lead us in a later study, not particularly this study, but in a later study in 5 years, come back and state we may need to pare back how much are allocated to illiquid investments.
Which, by the way, when we were brought in to this fund after the Great Financial Crisis, the fund itself had a mini asset liability crisis. And one of the things we had to recommend was essentially a diet on illiquids, which had grown to be a very substantial portion of the portfolio, which exacerbated the problems in the Great Financial Crisis for this fund.
A complementary chart to this one is on page 13. You, like many other pension funds, run at a negative cash flow. You're paying out more than the contributions that are coming in. You can see that runs at a pretty even pace at 3.5% until we get to that same cliff year I mentioned, 2038, and then 2039, we're seeing the percentage of the contributions to cover benefits become a much greater negative cash flow for the pension fund. Again, putting a lot more stress on the assets to be able to pay benefits. Doesn't mean you can't grow the assets. It simply means you need to shift how you grow those assets from relying on private investments to liquid investments.
So to Mr. Miller's question, or Mr. Miller's question earlier, as you approach that period, the question of how much liquid assets you need to have will differ. The answer to it will differ than it does today. Does that make sense?
I'll fast forward to page 19. Page 19 shows you the deterministic sensitivity analysis of the portfolios we put together. Again, this is based on the assumption that only in a certain period will we vary the return
of the portfolio and then assume that the return returns to the same thereafter. In this case, we're showing a baseline, which is your current portfolio, your payout ratio at 8%. I think we've defined payout ratio at the last meeting or at a prior meeting where we said anytime you pay out benefits, it's the percentage of benefits being paid out relative to your market value of assets. Any number of payout ratio below 10% is actually a pretty healthy payout ratio. When you get over 10%, it tends to stress the assets. You're paying out quite a bit of the assets each year to make sure you're paying your benefits. In this case, you're showing an 8% benefit payment for the baseline. The two variants I'll talk about are the V-shaped market event and then the low and then the loss and low event. With the V-shaped, it assumes that you lose in the first year of our 20-year projection, you lose 20% of the assets in the markets. You then recover 20% the next year, and then you resume your assumed rate of return of 6.875% thereafter. You can see that's the middle of the V. In the middle of that table, you can see your payout ratio remains the same, but at the very bottom, you can see your projected market value funded ratio moves from 99% or nearly 100% funded down to 92. Still a healthy percentage for your funded status. But you do see at the bottom the contributions as a result of that do go up by about a little over $10 billion. It's pretty hefty contribution that has to cover that particular loss early in the assumption period. The second one I'll talk about is the loss and then low return. It assumes that you have a loss, immediate 10% loss in the first year, and then thereafter, as opposed to meeting your assumed rate of return, you actually assume 100 basis points less than that, 5.875% return. And what is the impact of that? Your funded ratio goes up to 10%, so it's a bit more stress on the portfolio. Your funded ratio does not achieve 100% funding, but rather 80%, still semi-healthy. But what you also see at the bottom is that the contribution that's expected from the employer-employee does go up to a total of $55 billion. So it's a pretty significant impact to having a market that isn't precisely as the actuary would project.
So why do we do this analysis? This is important to understand. The actuary's assumption, and this is not negative to the actuary at all, that you will each and every year make precisely the same amount of money with no downturns and no upturns is simply, it's an unrealistic assumption. So we have to use this tool and ask the question, what about downturns? How bad do they hurt the outcomes of the fund? How much more expensive do they make the plan? How much do they impede your movement toward full funding? And the answer is volatility is your enemy in the plan. And you may recall earlier, my colleague Jason pointed out that you are slightly more volatile than your peers, than the peer group that we're using, but you've been rewarded commensurately for that additional risk. But there are declining marginal returns to that. And it is a potential issue that will be discussed during asset allocation, because the lesson for this is volatility harms as a risk to achieving the purpose of the fund, which is reach full funding and do it at the most reasonable and least expensive cost to contribution streams as possible.
My last two pages, we'll first start with page 24. And to Jim's point about volatility, what we've done is we've taken the actual portfolio and we've compared it to several other scenarios that you can consider. We've provided two bookends. One that states if you believe that you want it to be as low risk as possible, you'd have 100% allocated to fixed income. That's the first column, or the green box. To the extreme on the other end, on the right side, you'll see if you wanted to go and add as much risk as possible, but still stay liquid, it's 100% liquid equities. That's on the far, that's 100% there. You can see the bookends at the bottom. What's important is the expected compound return. That's the risk-adjusted expected return for the portfolios. For 100% fixed income, you can see a return of 4.2%, risk-adjusted. This simply says that that's not acceptable here because your assumed rate of return is far above that.
You would have to supplement that with a huge increase in contributions in order to pay benefits.
Conversely, if you look at the 100% equity, naturally you would believe that this should satisfy your assumed rate of return. And it does on an arithmetic basis But when you add risk to that, and Jim talked about the effects of risk, upside risk everyone loves, downside risk is what really hurts the pension fund. You can see the effects are pretty dramatic. The risk of equities only, it takes that return down to 5.8%, still below your assumed rate of return. What is far more reasonable is a diversified portfolio, which is what you see in the middle. And here's just a preview of what we'll provide you with the asset allocation study. We show your current policy in the middle. To the left of that, we show you what would happen if you decrease the risk by some measure, and we simply shifted from public equities to fixed income, or if we could increase the risk in a portfolio, again, shifting from fixed income to public equities. At the bottom, you can see there the compounded return, not too different. And so your portfolio is fairly decently positioned, but it doesn't explain the full story that we mentioned, that in the future, there could be more demands on this portfolio. And so we have to make this asset allocation decision at the next meeting in the context of knowing what the cash flows are for the pension fund. The last page that I'll cover will be page 41. It simply summarizes all the data of the study into one table. We talk about the different scenarios for 100% fixed income through 100% equity. We look at it from a mean standpoint, the 50th percentile. We look at it from the worst case scenario, which is 5th percentile, to the best case percentile, which is 95th. We look at it for the contributions as well, which is important, but also the payout ratios for the plans. We look at it over 3 different time periods, 5, 10, and over a 20-year period.
So to recap, your plan circumstances, as you can tell from these charts, are quite unique. You have this contribution cliff. You're making up for the great financial crisis. This is really important, that to get the correct asset strategy for investing the assets, you have to understand where you are and what your circumstances are. Second thing is, you can reach full funding if under the current assumptions, if those assumptions are met and you are patient enough to wait about 21 years. Now, that's not a long time in the life of a perpetual fund. And DB plans move like battleships. They turn very, very slowly. But you have to meet your actuarial returns. Your contribution policy as it stands today has to remain in place. You do have a solidly diversified portfolio. And as my partner Tony said, it's in that general sweet spot where it's not so conservative that you're leaning too heavily on contributions, nor is it so risky that you actually that the volatility actually erodes your compounding return. So there are modest changes that you can make, which I'm sure you'll discuss. But the point is that your current policy is in that range right now. Our analysis suggests that there are diminishing benefits to adding significant risk beyond this. You can tell from what my partner Tony said about how volatility actually erodes returns and therefore raises contribution levels and increases stress on the assets. And while it's early, it's not too early to start understanding that there will be a time to think about that contribution cliff and what you might have to do with respect to adapting your investment strategy to a higher payout ratio and a higher net negative cash flow. So you will not have a more comprehensive picture of your plan, which is the purpose for the investment committee itself, until we do our next one. So I invite you to ask us any questions along the way. We don't care whether it's today, next month, the month after, the coming year, because you won't see another picture of why you invest in the first place until we do our next AL study. So I'll stop there. Tony, did you have anything else?
Those are my closing comments.
Okay, fantastic. Important point of view to look at once every 5 years. I think we target to do that. So good. And a number of board members have expressed interest in how much we have in any particular asset class. The next iteration of this, the asset allocation study that the team just referenced, coming up at the December meeting, Bill, that will be the time to talk about how much of what we have or what's missing or what we want to move away from. So keep that in mind. This is a great perspective. And are there any questions? I don't see any hands up on the virtual side. Okay, fantastic job. Oh, sorry, Representative Miller.
You had talked about increased risk. volatility. Mike, and I just want to understand that word volatility. It is. Are you saying? Is that a catch-all phrase, the term volatility, or that volatility itself reduces returns?
It's the latter. A compound return is the return over a period of years. If there's no variation, then it's simply the return that's achieved every year. But every time, to give you a sense of the math behind it, if the asset base were to, and this won't actually happen, knock on wood, if the asset base falls by 50%, then a 50% gain the next year doesn't take it back to where it was. It takes it halfway back. And that's the penalty that volatility can impose on a stream of returns over many years. But there are other kinds of risk in the portfolio, some of which you discussed when you discussed your private investments today. In the investment report, there's credit risk, there's inflation risk, there's a number of other risks, but volatility is one that actually happens to be among the most common, and it integrates into your asset allocation study, which your staff and we will lead at the next meeting. I hope that's responsive.
Yeah, I'm just trying to understand the difference between risk and volatility.
There's multiple kinds of risk. Volatility is one of them. Credit risk is another. Inflation risk is another. You can go on down the list.
For us, in our perspective, when we think about risk, it's about the downside, the probability of a loss to your pension fund. That's when we think about risk from an investment standpoint, it's that downside potential loss.
And in fact, you will see in this study, but also in your asset allocation study, we will analyze for you the possibility, the probability of downside losses of various sizes. We're not so worried about the upside gains. They'll take care of themselves. But our job for you is essentially to try to see around the corner and see if there are problems and how big those problems might be and how probable they are of occurring. So we'll have a very good discussion of that in what's called a Monte Carlo analysis when we come back with an asset allocation study.
Okay, I may be one of those reaching out to you with questions. So
yeah, feel free. We actually welcome that.
Thank you.
A lot of those risks feed into the volatility. That's what they ultimately impact. If there's losses and what have you, it shows up in the volatility. And like Jim said, you have a 50% loss, you need 100% gain the next year to get back where you started. So good example, Jim. Thanks. Matt?
I know you mentioned we'd have to start thinking more about liquidity once the employer contributions start to drop off in 2038. Is that something, and you may have mentioned this, we need to start thinking about the next 5 years? Is that something we should start thinking about the next 10 years?
So think of it this way. In 5 years, you had a private equity investment present to you. Private equity typically is a 10 to 12-year lockup. So if you think in 5 years, I know that in the next 10, I may need additional assets. In the next 5 years, I need to think about what I'm allocating to, because I'll lock that up. And so that's when we say that that's probably the right time to think about. It depends on where the market takes the portfolio. It depends on where inflation is. Inflation is going to raise salaries, which is going to raise the benefits when they retire. So there are a lot of factors we have to think about. So in 5 years, it'll be a very significant conversation to say, do you have enough liquidity in the next 10 to 15 years to pay benefits without having to sell in a distressed market these liquid assets? For sure, as Tony said, you want to backtrack from that to 2038, at least 10 to 12 years. You know you're going to be discussing it then. But if for some reason the markets have been very unfavorable, or your actuary comes back and says your funding level's been hurt by disabilities, by salary increases, by whatever the case might be, then you could be talking about that earlier. But it's not pressing on the table today.
But it's going to be coming up pretty soon, I guess.
Well, I'm the oldest guy in the room, so pretty soon to me means something different than young people like you.
Even though RVK does a deep dive on the asset liability study once every 5 years, we do go through a stress test with our actuary every year, and we think about liquidity every day. We monitor our liquidity every day. We take it, but the stress test is every year. We do the 20% downside as well as, downside over an extended period of time as well with the Corn Ferry.
Since the GFC, this fund has actually handled liquidity pretty well.
Thank you for that comment, Jim. We work hard to make sure that happens. So glad it's recognized. Thank you, team, for that excellent summary, keeping it close on time. Any other questions or comments thus far on any topic that we've covered? Nothing at the moment. Okay. The next section we have on our agenda points to the executive session, but we don't believe we need an executive session unless somebody has a specific question on the material in the executive session, which is made up of 3 components. There's a quarterly investment manager monitoring or watch list, of which there's one particular investment that's of concern that we'll hear about when we come back into public session in a moment. If we go into executive, if not, we'll be hearing about it directly. And then the consultants, all 3 of them are RBK, our general consultant, Stepstone, our private equity, and NEPC, our real estate consultant, have done fee benchmarking reports to show how we've stacked up against that. Meredith Jones and Jeff Meyer in the room here. We're overseeing that, and also the annual investment manager fee and expense report, which, again, that's something we would have to discuss in executive session. If there are any questions, I will point out the enhanced section on the portion of the private market returns that go to SERS in the typical 80-20 split that happened, also referred to as carried interest, 20% towards the manager. But the report shows the significant sum that SERS benefits from these private markets, which Tony was just talking about. That is why we're in them, but we have to be mindful, as Matt pointed out, the future cash flow needs, because they do take 10, 12 years, like Tony said, to get the full realization from those assets. So with that, does anybody have any questions about the items in executive session? Because if not, we can go back to Ori for the last public session motion. Appreciate that. Or Chair Monson.
All right, so moving ahead to the investment manager evaluation quarterly update. Is it just making, I know the materials have been shared with the board. I guess just bring up the motion.
Yes.
Okay. So based on the information that had been provided, do I have a motion to recommend that the State Employees Retirement Board approve the orderly liquidation of the global public equity portfolio managed by Walter Scott and Partners Limited, and transition of the proceeds of such liquidation to SERS cash account? Upon completion of this liquidation and transition, SERS relationship with Walter Scott and Partners Limited will terminate.
So moved.
Is there a second?
Second.
It's moved and seconded. Are there any questions, comments? Seeing and hearing none, I will ask for a roll call vote.
Secretary Munson.
Aye.
Mr. Enders.
Aye.
Mr. Faber.
Aye.
Mr. McCary.
Aye.
Mr. Galuska.
Aye.
Treasurer Garrity.
Aye.
Thank you. Mr. Lindsay.
Aye.
Representative Miller.
Aye.
Ms. Buchanan.
Aye.
Thank you. Mr. Soderstedt.
Aye.
Thank you.
Okay, motion passes. Couple of informational items.
Yes, if there's any questions on the items in section item number 9 of your docs, asset allocation report and the rebalancing update that have been conducted, that's one of the things that the plan does to work to control that volatility that the RBK team was referencing, is rebalancing the portfolio. So if we have extreme movements in any particular asset class, you're expecting to get the targeted return. We rebalance back. So that material's in there for your review, and any questions on that now or anytime in the future, feel free. And with that, Chair Monson, thank you.
Okay. The next regularly scheduled committee meeting is December 2nd, 2025. And with that, I will ask if there is a motion to adjourn.
So moved.
Is there a second?
Second.
It's been moved and second. All in favor of adjourning, please say aye. Aye. Any opposed? Ayes have it. Thank you all very much.